VICI Properties is down by 9.19% over the past year, and over the past 5 years they are up by only 16.44%, which means that they have underperformed the market quite drastically over the past year, up by only 16%, while the S&P 500 is up by 83.70%. Now, what we have to understand is that VICI is a dividend yield, and that means that they have a very high dividend yield of almost 6% with a very high dividend growth. If we go to the dividends tab and go to dividend growth, we can see that their 5-year dividend CAGR is sitting at 7.70%. So on average, they have been raising their dividends by 7.70% yearly. And so if you were reinvesting the dividends you got from VICI over the past 5 years, it wouldn't return 16%, but it would return 54.10%, which is still below the market return, but accounting for the compounding rate over the next 10 to 20 to 30 years, VICI might return much more than the S&P 500. And currently the company also has 3 buy ratings, a buy rating from the SA analysts, a buy rating from Wall Street, and a strong buy rating from the quant. So jumping to our stock valuation spreadsheets, let's plug in VICI's ticker and wait for all the metrics to show up. Now, as always, if you want to download these spreadsheets for your own personal use, you can always do so in the link in the description. Now, right away, we can see the very sweet dividend yield of VICI sitting at 5.87%. They also have a quite high trailing FFO payout ratio. FFO stands for funds from operations, which is a metric used instead of the free cash flow when evaluating REITs. And we can see that the trailing FFO payout ratio is sitting at 70.45, which is a little too high for my taste. But let's see if it puts the company and their dividend payouts into danger. So jumping to the fundamental 9-pillar analysis, let's have a look at how much debt the company has. So looking at the long-term liabilities over the 5-year FFO negative dividends, currently sitting in the green at 2.57. And this metric basically tells us whether VICI generates enough FFO to cover all their long-term liabilities while paying out their current dividend. We generally want this metric to be below 3, which would tell us that a company can pay off all their long-term liabilities in about 15 years. And as we can see, VICI would take about 12 years to pay off all their long-term liabilities with the current FFO they generate. So the debt VICI currently holds doesn't put the company or their dividend payouts into danger. But now let's also have a look at their profits growth. We can see that their revenue has been growing at a rate of 35.5% yearly on average. Their FFO has been increasing by more than 50% yearly, and their net income has been increasing by more than 50% yearly as well. Now let's zoom in onto the net income, and we can actually see that the main growth occurred between 2023 to 2024, where the net income jumped by more than 100%. Throughout the other years, the growth is actually sitting between low and double digits, and that is the same case with the FFO. There was a big jump between 2023 and 24, and the growth is actually sitting between low and double digits as well. But don't get the wrong idea here, lower double-digit growth is actually still above average, and so VICI is actually growing very, very well. They also have a very high 5-year profit margin sitting at 83.61%, which is also great. Now, one thing I don't like about the company is that they have been increasing their shares outstanding at a very high rate. And we can actually see that on the graph, VICI has grown their shares outstanding from 435 million in 2020 to 1 billion in 2024. That's a huge increase. And it is diluting the market, decreasing the long-term value of the shares you hold as an investor. So I don't really like VICI increasing their shares outstanding by this much. Now, one thing I do love about VICI as a long-term investor is that currently they seem to be trading undervalued. If we have a look at their 5-year PE ratio, it is sitting at 16.63, which is well in the range we like to see. Now, as VICI is a REIT, we don't really want to be looking at the PE ratio, but instead have a look at the 5-year price to FFO, which is as well sitting at 16.42, well in the range we like to see. And if we zoom in, we can indeed see that on average over the past 5 years, it was sitting at 16.42, and in 2024 it dropped to 12, and currently it is sitting even lower at 10.9. So investors are underpaying for the company, paying only $10.90 for $1 of VICI's funds from operations. But let's figure out if VICI is actually trading undervalued and jump to our first intrinsic valuation model, which is the historical price to FFO model. And here we will take the historical price per share, the historical FFO per share, and calculate the historical price to FFO, which we will average out and get an average price to FFO of 14.18 over the past 5 years. We will then compare this to the current price to FFO of 10.9 and get an intrinsic value of $38.34. And this tells us that VICI is currently trading cheaper than what it was trading at over the past 5 years. But let's also jump to our second valuation model, the discounted FFO model, where we plug in the FFO over the past 5 years and calculate the average growth rate to be sitting at 52.82%. Now, as we know, the actual more realistic growth is sitting at the mid digits. So I will plug in a high growth of 11%, medium growth of 9%, and a low growth of 6%, as we are predicting into the next 8 years plus, and so we do have to be a little conservative. Now I will average out these three growth rates into a growth rate of 8.7%, and using this I will calculate the future FFO. After that I will plug in a discount rate at 10.5%, which is essentially the minimum rate of return I would like for my investment, and using this discount rate I will calculate the present value of that future FFO. I will then sum all of that up, add cash and cash equivalents, and subtract total debt to get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $37.21, which is higher than the current trading price. But now let's also compare VICI to some of its competitors. So we'll take 3 of VICI's peers, we will take their stock prices and divide by their FFOs per share to get their price to FFOs. We will then average these out and multiply by the FFO per share of VICI to get an intrinsic value of $28.59, which is a little lower than the current trading price, which hints that VICI is actually quite fairly valued compared to its competitors. But now let's jump to our final valuation model, the dividend discount model. And here we will take the dividend payouts over the past 5 years and calculate the average growth rate to be sitting at 8.31%. Now I do want to be a little conservative, so I'll project a growth rate of 7.17% into the future and get an intrinsic value of $51.64. And this is where we can really see that VICI is valued very highly compared to the dividends they pay out and compared to their dividend growth. And so now let's move to the ultimate valuation, where we will average out the 4 valuation models and get an intrinsic value of $40.12, which is 36% higher than the current trading price. And with a margin of safety of 15%, we would get an acceptable buy price at $34.10. So the company would currently be considered a buy. Now to me, VICI is looking as a fairly good investment. They do have quite low debt, they have very nice growth, and they have very decent dividend payouts and dividend growth. But if you want to add this company to your portfolio, make sure to do some more research in the back end. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out. And let me know if you already own VICI or if you will add it to your portfolio down in the comments.